Hello, I'm David Talbot, Managing Director and Head of Research at Red Cloud Securities. We wrap up this morning grouping of uranium companies with International Consolidated Uranium. We welcome Phil Williams, CEO, to speak to us about Consolidated's unique and highly leveraged business model of acquiring select uranium projects. Phil, you've got 15 minutes, and then we'll have a 5-minute Q&A at the end of the session. Attendees, please feel free to ask questions using the Q&A link below. Take it away, Phil.
Thanks, Dave. And thank you, Red Cloud, for asking us to present at this year's Pre-PDAC Mining Showcase. Got the presentation here. We'll get through it in 15 minutes. And so let's get started. Usual disclaimers. So International Consolidated Uranium is a relatively new entrant to the uranium sector. I joined the company in March last year. And by May, we had done our first transaction in the space, acquiring projects in Australia. And really, the model here is to capitalize on the resurgence in the uranium market by executing a consolidation strategy. And as we talk about the highlights here, the uranium sector has recently emerged from a 10-year bear market. And this is why we thought that we should enter the space. And consolidation represents a proven strategy. And we'll talk about that as we go through the presentation. We think that the company is uniquely positioned in the space based on our team. As I said, I joined last March. I have an extensive experience in the uranium space, but we also, importantly, the company was founded by the guys behind NextGen and Mega Uranium, names many of you will be familiar with. And since I joined, we've also added a number of other people who bring decades of experience in uranium. What we've done in a short period of time is we've made 5 different acquisitions. On the right-hand side of the slide, you can see the projects in Australia I mentioned we've acquired. We've also acquired projects in Nunavut, Labrador, Argentina, and Quebec. We'll touch on all those projects as we go through the slide. The one thing we won't spend a lot of time talking about is the company was originally a gold company, and we do have a couple of gold projects in the portfolio, which we think represent further upside, and we'll be looking to monetize or equitize over time. Just touch on the capital structure. We've had a very busy year on the M&A side, acquiring these projects. We've also been very busy financing the company and bringing institutional investors to the register. In fact, tomorrow we'll be closing a $6 million bought deal financing that was co-led by Red Cloud and another dealer. And importantly, so that represents, that's the 4th financing that we've done since I joined the company. We've raised over $15 million. In fact, we have over $15 million on the balance sheet now post that raising. I think the most important part about all the fundraisings that we've done is they've largely been subscribed to by institutional investors, both uranium-focused funds, and we mentioned 2 of them on the slide here, Sachin Cove and Sagra Capital, but also general resource investors and other generalist investors around the world. We have investors in Canada, the US, Europe, and Australia. And then we have Dave Talbot as our only covering analyst at the moment. We're not going to spend much time talking about the uranium market. We obviously are bullish on the space. We just think fundamentally spot price or all uranium prices need to be higher than they are today. And we're quite encouraged by the positioning of nuclear power in the climate change playbook. It's getting a lot more traction, I think, as most of you would know, and as Dave Talbot would be talking about regularly. So consolidation, why are we going on this tact? And I think this chart sort of says it all. We're using Mega Uranium as a guide. And so early on, as we were establishing the model and sort of back testing it to make sure that it was sound, we put together this table, and this was the early days of Mega Uranium. Some of you might be familiar with the company. This is from 2005, beginning of 2005 to the end of 2007, and they were deploying this strategy. And over that period of time, they made 9 acquisitions. They raised $50 million in capital. And in this time frame, you can see in green, uranium prices were rising, and ultimately they peaked in early 2007, just after this chart. But over that period of time, Mega's share price increased by 25 times, and the market cap went from 15 million to 940 million. So of course, we think that's that's a great trajectory and the kind of performance that we would like to emulate. And of course, we have not only the benefit of hindsight, seeing how they did this and what they did, but we have a number of members of the team that helped do that involved in the company. And we'll talk a little bit about that. And then also on the sort of right-hand side of the chart, consolidation is great at the beginning, and you'll see how we've been able to put together a portfolio of assets at very reasonable prices relative to their historic values. But it's what you do after is also equally as important. And again, here we have a guide with Mega Uranium, and you can see what they did with a number of these acquisitions. They were able to spin them out, sell them, create new companies, and generally create value for their shareholders along the way. And importantly, one of the main things that they did was they took a portfolio of Canadian projects, sold it to NextGen, and that was where that became the Arrow discovery. And this consolidation, Mega wasn't the only consolidator back in that initial bull market. Names like Paladin, Energy Metals, and Uranium One were also consolidating and being very successful. Talk about the team. My background, I've been in the finance business for over 20 years, significant amount of that time in the uranium space. I was a sell-side research analyst covering uranium back in 2006. I've also been on the buy side, and I've been an investment banker in the space. Recently, I started a private uranium royalty company that went public, and so I've had sort of 15 plus years experience in this space. We've added a new CFO, VP corporate development, Pete Mullins. He also has decades in the uranium space and in geology. Pete Mullins was part of Laramide Resources, some of you might be familiar with from the very beginning. We've also added new directors over the last year, but importantly, we've kept that sort of initial uranium DNA. Richard Patricio, the CEO of Mega, is our special advisor. Lee Currier, the CEO of NextGen, is on the advisory board. And we've recently added Ted Wilton to the advisory board. He's a senior uranium geologist with a particular focus on the US, which is a jurisdiction that we're not in right now, but certainly one that we're looking at. So as a summary overview of the projects, these are the projects that we've acquired. You can see where they are around the world. I think the important part here is that all of these acquisitions have been done with purpose. And we have sort of rigid criteria that we look at when we're evaluating project acquisitions. We're trying to diversify our portfolio, both across geography, stage of development, deposit type. We also look for projects that had significant past expenditures. We're looking for projects that have resources in the ground, and we'll show you that each one of these projects fits that category. We're also looking at projects that captured significant market cap in the past, and I'll talk a little bit about that. And when we talk about the terms, I think we've done a very good job buying these projects right and coming up with creative acquisition structures which is a competitive advantage for us in getting more deals done over time. This is the historic mineral resource table. We won't go through this too much. I think the thing that I would highlight, again, each project has resources, so we've got quite a substantial base now. But also several of the projects have vanadium as well as uranium. And we do see that in uranium, quite a lot of deposits, or definitely many deposits have vanadium as well. We see that as an upside. We're buying these projects primarily, of course, for uranium, but getting the vanadium as a byproduct credit can definitely improve economics. And vanadium itself is having a nice rally in terms of its price. And we think that that's a kind of sleeper part of the value of the company, and will potentially be attracting investors on its own as we go forward. So we'll jump into the projects. We'll go over them relatively quickly in light of the time constraints. First, this is the first, and the projects are all in the order of acquisition. These are the first projects in Australia. We acquired these from Mega Uranium. As we talk about significant expenditures here, so between the two projects, Ben Lomond and Georgetown, $30 million has been spent. These projects were quite advanced historically. There were applications to mine Ben Lomond particularly. It never happened for geopolitical reasons, and that's a big theme within the uranium space, and something that we're obviously cognizant of and think that we can take advantage of over time. What we like about these projects, particularly, is that Ben Lomond has the potential to be a high grade, low capex deposit or mine, and we're undertaking some work to evaluate it on that basis. And here we talk about the work programs. One of the tenets of our strategy right now is that we're in the consolidation mode. We're not spending huge sums of money on any of these projects until we see the move in uranium is for real. And what I mean by that is the price rises significantly from where it is. And so the work that we're doing here is mostly on pulling together the old data and putting together the plans that we would undertake when we see the time is right and that the market will reward those kinds of programs. I think importantly, this is a good time to talk about the kinds of deals that we're doing in the structures, and you'll see at the acquisition terms here are duplicated pretty much in all of the acquisitions that we've done. In this case, we made an upfront payment of cash and shares in order to secure the option to acquire the project on a 100% basis for a period of time. In this case, it's 2 years, and the payment amount is fixed, so it's $3 million to acquire these projects, and we can pay for them in cash or shares. And we did this deal in June of last year. And what was important about structuring it this way is that it gave us the ability to go out and do more acquisitions, get the story more well known, potentially increase the share price, which has happened. And when we do go to execute that option and exercise the option and take 100% interest, we believe it'll be quite a lot less dilutive than it would have been at the time that we announced the deal. We've also got contingent payments, and you'll see this theme as well, where we're giving the counterparty some upside to the future price of uranium. You can see at different levels, 50, 75, and 100, we have further payments to make. And again, those payments can be made in cash and shares. Second project that we acquired is from ISO Energy, Mountain Lake in Nunavut. Again, this project has a historic resource, had significant expenditures on it in the past. Previous owners before ISO were Proiect Minerals and Pitchstone. Some of you might remember those names from the past bull market. Collectively, they had a market cap of almost $200 million in the peak. The plan here would be, and again, this is a staged acquisition. We have 2 years to make the determination to acquire it. And we're not doing any work here, but we have a plan to follow up some high grade that was previously identified when we do go into the project. The third project that we acquired is in Labrador in the Central Mineral Belt. This map, quite interesting actually, it's been updated recently, and in fact you'll see that all around us, Altius Minerals has recently staked a huge ground position. So we think that this area is exciting and heating up. We've got one of the biggest resources next to Paladin's Michelin deposit, which is also in the camp, and we have vanadium here. And we think that there's some very interesting exploration potential, not just for uranium and vanadium, but also IOCG. The acquisition terms are there, and again, this is some upfront payments. We have 3 years in this case to exercise the option, and then some payments contingent to the price of uranium. And the most recent project that we acquired is in Argentina from U3O8 Corp. It's the Laguna Salada project. Again, fits all the categories, checks all the boxes. 15 million spent on it by U3O8, significant market cap previously. They've done quite a lot of work here. In fact, there's a preliminary economics assessment that they filed in 2014, and this project also has vanadium. And we recently just staked this the Dieter Lake project in Quebec, which has an inferred resource and was owned by names that you would know, Denison and Fission in the past. Just two seconds, Dave. We've got we think based on the resources that we have, just on a metric, which is a very basic metric, EV per resource, we're trading at the bottom of the range, and so we think there's quite a lot of upside. Of course, the business plan is to continue to acquire projects. We've got a good portfolio to start, and we've got a team that's going to be very active. We've got a number of targets in our pipeline of new deals to do. We're well capitalized. That $15 million that we have now is fully earmarked for new acquisitions, and then we've got a team that has decades experience in the space.
Okay, good timing, Phil. No rush there. We still have another 5 minutes here. So you mentioned rigid criteria for M&A. What is your main M&A criteria when looking at uranium projects?
Okay, so we take a project first approach, and because of the experience that we have as a team, we've often been to the project, spent either been involved in it in some way, potentially even either financed it as a banker, as an investor, or been part of the management team. So we're really looking for projects that have characteristics for development. But the other thing is, and then I highlighted exploration expenditures. So we want to see money already in the project. We want to see projects that carry big market caps in the past, where we think we can get them for pennies on the dollar. We also want to diversify. And one of the things that we know from the past 15 years in the space is that project companies with single assets in single jurisdictions can be at risk to geopolitical uncertainty. And we've seen that time and time again in the space. And so we want to make sure that we've diversified across the spectrum. And so when we look at the projects, again, we take a project first approach, but we look at how it fits within the portfolio.
Okay, thank you. Here's a little bit of a loaded question from the audience. Maybe you can't answer this, but have you looked at Valour Metals, formerly Kivalic's Angelac project in Nunavut? That's 43 million pounds, grading 0.7%. I wouldn't say it's non-core to Valour, but certainly isn't a focus of the company right now.
So behind me on the wall is the map of every uranium project in the world. We've looked at everything, and that's a great project. I mean, and that if you took that project and put it into our sort of checkbox, it would check a lot of boxes. So it's certainly an interesting project, and I mean, I can't say anything specific about it other than we have looked at it, and I think it's a great project.
Okay. Do you plan to carry out any physical fieldwork exploration or try to improve any of the assets in your portfolio, or perhaps enter into JVs?
So the two projects that we have, one in Quebec, Dieter Lake, and the one in Labrador, we have some minimum expenditure requirements over the next kind of year to 2 years. Those are quite minimal, in less than $200,000 in total. So we will be spending some money. I think as far as the other project goes, and especially in this period, in this option period, before we've exercised the option, we're not going to spend a lot of money on any of the projects other than pulling together old data and making plans for what we will do. And that's in Pete Mullins, and Pete's brought on a new geologist to work with him to get all that information together. But really, other than spending a little bit of money in Quebec and Labrador, we're not planning to spend much money this year. That could change based on new acquisitions that come into the portfolio, though.
Okay. And that's your typical MO, right? Buy it now or option it now and pay later.
Correct. Pay later with shares or cash, but at a higher, but raising that money at a higher share price, so it's less dilution to the shareholders today.
Great. The global COVID situation, does that currently benefit the company's development, or do you find that slowing you down somewhat?
Again, I mean, we're not carrying out that much work on the ground, so it's not impacting us that way. I think the way that it has impacted us is without the ability to travel. When we look at jurisdictions and we look at projects, new projects to acquire, even the projects that we have acquired, we need to make sure that we have reliable, trustworthy people on the ground to do the things that need to be done. And in each case, we have a team. We've taken on a project where we've known groups to help us in those jurisdictions, or we bring a team in with us, and you can see that in the Quebec acquisition. So you have to be very strategic about acquiring projects in far off jurisdictions when management can't go to those projects directly.
Perfect. Okay, well, we are out of time. Thank you very much, Phil Williams. Thank you, everybody, for joining us.